Good afternoon, this is Brian Shannon from Alpha Trends. Today is Friday, the 29th of February, 2008, and the market's closed, and we had a resumption of the primary trend here today. The market has been kind of just moving back and forth in a range, and I've been outlining that range as basically 140, 139 and change down to about 132. So it still remains locked within that range, but the fact that it found resistance near that declining 50-day moving average continues to make me believe that we're still going to see a resumption of further selling here on the weekly time frame, and the volume dry up in the last several weeks kind of just indicates that this market's been rallying slightly and trying to find some support, but there really hasn't been conviction there. There's been a lack of buying, and this week we had a little bit of increase in volume, and next week if we see some kind of capitulation and move below 132, I would expect that that volume is really going to swell once again. But let's just take a look at the trends here. Earlier today I had outlined a couple of areas in the market that looked like they were going to be support and resistance, and what I was looking at first of all was the resistance up there, and let me just change this to get a few more days in here. I've only got 20, so we'll look at 35. And here now we can see that range a little bit more clearly down to the 132 level. We also saw that this little trend line that's been kind of defining what was that on the daily time frame, what was looking like the symmetrical triangle, but kind of that pattern kind of got messed up and it looks more range bound. But this was that lower trend line, and it did find support once again in there today. This market got a little bit deeply oversold. I think 2.5% almost today. Doesn't mean it can't continue lower. What I would like to see early next week is maybe a little bit of a retracement of this sell-off, suck some more longs in if the market could rally up towards this prior low. I doubt it can get that high. Maybe even up towards here, up just under 136. If it could rally up towards that and then sell off, take the 132 out. That's a lot of guessing here, obviously, right now. But the bottom line is we remain locked in this range. And yesterday we saw in the 10-minute time frame, I was pointing out that even though it looked like this 137 level might be acting as support, when the primary trend is lower, that there's a lot of reason to be nervous about the market. We have these lower highs and lower lows here, and we had also seen that the support from I guess this was Tuesday and Wednesday did act as resistance yesterday. This morning we had the gap lower and sell-off, consolidation, and another smashing here. They found a little bit of support into the close down near that 133 level, but that's probably just some big short covering position in there. I wouldn't read too much into that late day strength because clearly the market is very damaged in here, and like I said yesterday, that it seemed like there's a good chance of it breaking back to the downside. The path of least resistance is lower. We're in a bear market, and you start wondering when it gets up here, start probing those resistance levels. But again, the market is always considered guilty till proven innocent as long as you have a declining 50-day moving average and a declining 200-day moving average. You really can't have much confidence or hope that the buyers will be able to gain control. It just doesn't make sense. Just as looking for a larger sell-off within a uptrend up here doesn't make sense. The trend is your friend. And another thing that I pointed out earlier today as well was the VWAP line from the Fed emergency rate cut here of 75 basis points. Now you can see that now the average person who's bought the S&P 500 is losing. The only thing that can really save this market, and I don't even think save it, is just maybe buy it some more time, is if the Fed comes in and cuts rates once again. That's really, I wish they would just stay out of it and let the market trade based on what it's going to do, and then we don't have to worry about that. You can have more confidence in holding some good short positions. But the market is a little sold off. We found some support from these lows of last week late in the day today, and maybe we'll get a little bit of a bounce, but I don't think it's something you want to look for as far as a long side trade. The semiconductors are, let's take a look at the VWAP in there. Semiconductors They're below that VWAP line as well. We've got the this market is right back to its trend line, or approaching that lower rather trend line that's ascending in here, the ascending trend line that is. After finding resistance up near that 30.25 level once again. The XLF though, which we looked at yesterday, turned out to be a timely look at that as what appeared to be some strength in here Wednesday and Thursday, or Tuesday and Wednesday. Broke down yesterday. It got back below that 5-day moving average, and I was saying it doesn't, there's no reason to think that this market is going to hold near even this 26.25 level. I was thinking that if it breaks these lows from yesterday, that it's probably heading towards that 26.20 level. We saw the 26.20 level test and hold for a little bit of time, a little bit in here, but later in the day the selling resumed in there, and there was some nice sell-off. Nice pressure to the downside below that. Now this market, the financials, which again have been really the root of this sell-off, looks like they've got an inevitable date with a test of these lows, and maybe probably even head lower. Why wouldn't it? It's in a downtrend, guilty till proven innocent. So I think that we probably got a test of 24, at a minimum a test of 24 coming, if not lower lows. The market's badly damaged. If somehow it can get back above, I'd say about $29.30 early next week, then you would want to cover any shorts that you have in there. And I know a lot of people are aware of this, but the SKF is the double inverse XLF. So that's something you want to look at. For every percentage point that the XLF drops, this should rally 2%, is the way that is supposed to work, just like the TWM is to the IWM. The IWM, Russell 2000, we also saw that this market probed that resistance, or that found resistance at 72, right coincident with the declining 50-day moving average. And again, when that 50-day moving average is declining, as good as the intraday action may appear at times, the market is guilty till proven innocent. We'd seen that, of course, the bigger level in here is that $73 level. And the further we get away from that, I think that that's going to be an area that may plague this market for quite some time to come. But the time predictions are meaningless in here. But again, same pattern on the weekly sell-off, that the market kind of held its ground on light volume, but then it starts breaking down. We're seeing a resumption of volume. If we could get some bigger volume candles that bring it up towards this area, then I think that's going to be accompanied by a test of the lows near $65 a share. We do still have this level holding in here at the $68 level. If we take a look at the volume-weighted average price since the 75 basis point cut, you can see that the market gap below that, and now the average person who's bought is underwater. And the longer it spends time underneath this area of congestion, if it breaks 68, then that's just a whole nother group of market participants who are losing money. And if the market breaks down and then rallies up to that, you can expect that it would likely act as resistance as those people look to get out of the market and reduce or eliminate their losses. So still a lot of problems for this market, and they're not going away for quite a while. If you're still looking for long candidates, there are the occasional ones like that BEXP that I had pointed out 2 days ago and had a great rally yesterday, but you got to trade these things. You got to, bear markets are not a time to be an investor. And I think that goes for the downside as well, because the short squeeze, the short-term short squeeze rallies can be so violent in there. They can shake you out of your position, and then it completely falls apart again. The NASDAQ 100 had been testing this 4450 level. It actually broke above it yesterday for just a brief amount of time. But again, once that level holds, then it's likely that there's more people trapped up in here. This little uptrend, these higher lows, I've been pointing that out, saying that it looks like the market's trying to recover, but it's really hard to believe, and there's really no reason to think that the market can hold on. There's no reason to think that a bullish scenario will hold. And sure enough, it's not holding in here. If we look at the 30-minute time frame, it's still holding above this trend line, and you know, these trend lines, there's, you know, something that people call, I don't know who came up with it, but they call it the rule of 4, meaning that once a trend line has tested, you know, on the 4th test of a trend line, that's when it often fails. So I think we're getting very close to the resolution of this, you know, the symmetrical triangle that broke, and then it's, you know, back into that. You know, you can redraw your trend lines or whatever to justify it. The point is, though, that this level is in jeopardy of breaking. I don't think it does it immediately. What I'd love to see would be a rally, and it might not even be much of a rally. Maybe up to this this intraday level of support from today, up near about 43.20. If it can rally up towards there on Monday, then maybe we get a nice flush out underneath this, you know, beneath 42.80 or so, and then we see a move back to the downside, which I think could take this market to 40 or so. That's just a you know, it's not really a guess, but it's more you know, what I was looking at prior, you know, with that symmetrical triangle was the height of that. Taken away from the subtracted from rather the breakdown point, you know, gives us about a $40 target. So what we do is we take the height of this pattern here and subtract it from where the market breaks down, and that gives us approximately a $40 target. Again, we're in a bearish market. We're going to have bounces along the way, and they're going to suck a lot of people in. But as long as you see that 50-day and the 200-day moving average, the market is guilty till proven innocent. Any trades on the long side should be short-term scalps only.